Can Chinese companies still win in the U.S. market? And what does that mean for your portfolio? The short answer is yes, and the way they adapt could reshape sector leaders and ETF performance. Here's the context. Trade rules and security reviews keep shifting, and a trust deficit hasn't gone away. Yet the U.S. remains the biggest prize. Personal consumption is roughly $19 trillion a year, about 68% of GDP. That scale is hard to ignore. So firms are localizing operations, tightening compliance, and redesigning supply chains to keep access to American buyers. The policy backdrop is no longer one blunt tariff rate. After the early Section 301 actions that hit about $370 billion of imports, rules have become granular. Some inputs and intermediate goods now see adjusted treatment. Sensitive categories face higher walls. Electric vehicles are the clearest case, with tariff rates climbing toward 100%. That creates uneven competitive dynamics. Consumer and capital goods in less sensitive lanes may find workable paths, while strategic tech and EVs face steeper hurdles and national security reviews. Corporate playbooks reflect this split. More Chinese firms are forming U.S.-based entities and hiring locally to meet procurement rules and blunt political risk. Onshoring or nearshoring assembly is becoming part of cost of entry. Data governance has moved to the front office. Companies are building audit trails, local storage, and state-by-state compliance to pass scrutiny and rebuild trust with regulators, partners, and customers. For investors, these shifts ripple through indices and strategies. Sector weights can drift as sensitive tech names face constraints while consumer categories stabilize. Factor exposures like quality, profitability, and low volatility may matter more than simple value screens because compliance spend and localization can change margins and cash flow resilience. In credit, supply chain reroutes and capex for U.S. capacity can widen or tighten spreads depending on execution. In ETFs, look under the hood. Country labels can mislead if revenue is U.S. heavy, but operations are increasingly local. The practical takeaway: evaluate exposure at the product and policy level, not just the country label. Prioritize companies with clear U.S. revenue pathways, credible localization, and robust data controls. Be cautious in sectors flagged as strategic where rates and reviews can tighten quickly. And stress test portfolios for policy bifurcation. Some tariff lines ease while others escalate. Want the full breakdown and the numbers behind these moves? Read the full article at finlitica.com.